Welcome. In this video, when will the Xcn coin pump come? We will analyze it. Don't forget to subscribe, and please watch to the end to understand. When we take a broader look at the chart, one of the most striking structures that stands out is a long-standing, well-defined, and deep descending trend. This downtrend has gradually pressured investor sentiment, continuously pushed prices lower, and created a certain level of caution in the market. However, from a technical analysis perspective, the continuation probability of such long-term downtrends is limited, and these structures often lay the groundwork for a strong reversal after a breakout. It can be said that we are currently facing exactly such a scenario. By the nature of the descending trend, the price has repeatedly touched the trend line and been rejected each time. However, it appears that these touches have now reached a saturation point. In technical analysis, repeated tests of a trend line often indicate that the line is weakening, and the likelihood of a breakout is increasing. In this sense, it wouldn't be wrong to say that the price is now on the verge of breaking free from this downward structure. This trend line is no longer just a barrier. It has become a potential launching pad. Especially in recent periods, the price has been approaching this descending trend line with increasingly lower highs, which can be interpreted as a sign that the strength of sellers is starting to fade. This suggests that buyers are gradually taking control and becoming more influential in driving price movement. Additionally, the recent wicks pointing upward along with increased volume suggest that the market is preparing for a breakout from this trend. These types of early signals are positive developments that indicate an impending breakout and that investors are anticipating strong moves to follow. Breaking a descending trend typically represents a psychological shift in the market. The prolonged downward pressure is often replaced with strong, rapid upward movements as buyers regain confidence following the breakout. In such breakouts, particularly when initial resistance levels are surpassed, FOMO, fear of missing out, can kick in, bringing investors back into the market quickly. This can lead to sharp and fast price increases. The strength of the upward movement that can occur after this long downtrend is broken is often proportional to the duration of the trend. In other words, the longer the downtrend, the stronger and more impactful the breakout may be. Technically, these breakouts are referred to as trend reversal signals and tend to attract significant attention. For investors who trade based on technical analysis, such breakouts serve as buy signals and lead to increased position sizes and new entries. At this point, another notable detail is that the price appears to be positioning itself to break out of this long descending trend. One by one, the necessary conditions for a successful breakout are coming together. Volume support, increasing momentum, positive divergences, and indicators like the RSI giving bullish signals all serve as supporting factors. The positive behavior of these confirming indicators contributes to a highly favorable technical outlook. If the price manages to break above this long-standing descending trend line, it would not only signify a short-term rally, but also the potential beginning of a new medium to long-term uptrend. With such a breakout, it is highly likely that the market will begin moving toward higher targets, and that investor confidence will be restored. If the price manages to surpass the first resistance levels after the breakout, the market could even reach levels that were previously out of reach. But we cannot base an analysis on trend lines alone. Let's take a look at the other metrics as well. Stay tuned. The Elliott wave theory is a well-established and reliable method of analysis that argues markets move within a specific psychological structure and explains price movements through waves. According to this theory, every major trend consists of 5 primary waves, 3 impulsive and 2 corrective. The formation of these 5 waves is highly valuable for understanding market direction and forecasting potential future price movements. In particular, the first 2 waves, Wave 1 and Wave 2, form the foundation of the entire structure and provide the essential groundwork for the powerful third wave that typically follows. Looking at the current chart structure, it is possible to say that price movements have begun to exhibit characteristics aligned with an Elliott wave formation. Initially, an upward move that could be considered the first wave has appeared, bringing vitality to the market and offering the first positive signal. This first wave is when investors start taking positions, market interest begins to rise, and hopes for a new trend start to grow. Technically, the first wave is often a move that most people don't notice at first, but attentive analysts recognize. Therefore, the formation of the first wave is a very important signal indicating the structure has begun. The second wave, which typically follows the first, usually forms as a corrective move. This wave represents a phase when investors take profits, some hesitation arises, but also the market builds a healthier base. While this corrective movement may appear negative on the surface, it is actually quite healthy from a technical standpoint. These types of pullbacks allow the market to gather energy for a new breakout. Thanks to the second wave, the price exits overbought areas, indicators rebalance, and new buying opportunities emerge. In this sense, the formation of the second wave should be viewed not merely as a correction, but as a preparatory phase for a major upcoming rally. If the price structure successfully forms the first and second waves clearly, this results in a very favorable technical outlook. That's because the third wave is known in Elliott theory as the strongest and longest wave. The third wave is typically the stage that draws the most investor interest, involves large volumes of buying, and sees price move upward almost continuously. As a result, technical analysts focus heavily on identifying and capturing the third wave following the first two, adjusting their positions to avoid missing the opportunity. Looking at the current structure, the price action entering the process of forming these first two waves is a very positive development. Especially the increase in volume during the first wave, followed by a low volume pullback in the second wave, are strong indicators that this theory is working as expected. In other words, the emerging pattern is beginning to emit signals that are fully aligned with the classic Elliott formation. This suggests that in the coming period, the third wave may emerge with a strong upward movement. It's also important to remember that the psychological aspect of the market plays a significant role within the Elliott wave structure. While the first wave is often seen as a false rally by many, the second wave tends to reinforce that skepticism. However, once the third wave begins, the majority of market participants start to believe in the uptrend, and this belief increases participation in the wave. As a result, price movements become more voluminous, stronger, and faster. In other words, the current process, involving the first and second waves, serves as the foundation for the confidence and momentum that will shape the market. When all these factors are considered together, a highly favorable technical scenario emerges. The beginning formation of the first and second waves, the foundation of the Elliott wave structure, provides strong signals that much more powerful movements may occur in the days ahead. Accurately interpreting these signals and preparing strategies for the start of the third wave could lead to highly profitable outcomes for investors. MACD is an extremely valuable technical analysis tool used to assess market momentum and capture potential trend reversals. In particular, this indicator guides analysts in determining the strength and direction of the trend. The relationship between the two important elements, the MACD line and the signal line, gives serious clues about the future movements of the price. Looking at the current technical structure, we observe that the MACD indicator has shown an upward movement from the lower regions, and a significant convergence between the lines has begun. This development can be considered as a very exciting signal in terms of market dynamics, especially when the MACD line is about to cross the signal line from bottom to top, which is currently in the process of forming. This signals that bullish momentum may begin in the market. As we observe on the current chart, these two lines are getting closer and closer to each other, and the distance between them is narrowing, indicating that a possible positive crossover is very close. A positive MACD crossover usually means that the market is starting to recover from the bottom and a new uptrend may be forming. This type of crossover can cause traders to reopen a buy position because in technical analysis, these crossovers usually precede price increases. MACD crossovers are important. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.